Hi, everyone. We just wanted to take a moment to welcome you. Thanks for joining us, everyone. We're attending our second virtual Fireside chat series of YMP Vancouver. We hope that everyone is staying safe and healthy. For those of you who don't know me, my name's Jen. I'm a partner at Castles, and I've been involved with YMP Vancouver for over 5 years now. I just wanted to firstly thank our sponsors, and they're very supportive, with which we wouldn't even be able to put on these types of events. Those include KPMG, Castles, Integra, Barian Mining, Equinox Gold, Verify, and Solaris. We'd also like to thank YMP's global sponsor, Rio Tinto. I'd also like to acknowledge the YMP Vancouver executive team, as without their efforts, these events would also not come together. Big thank you to my fellow members, Mike Wooler from KPMG and Mal Karwowska from First Mining Gold. As we launch into the event, I just want to note that when you registered, everyone acknowledged that although not intended, because this session is being recorded, there may be circumstances where your voice or image could be recorded, although again, unintentional. Just finally, the structure of today's event will include about a 30 to 40 minute discussion, and then it'll be followed by a Q&A period. If you'd like to ask a question, please do so using the Q&A function that you can find on your screen. Chat will be open for participants to engage in discussion during the session as well. Lastly, not that we at YMP have specific IT skills, but if you do experience any technical issues with the video or sound, we suggest exiting and re-entering the webinar. Also, you can chat. If you have any issues, send us a chat. We're excited to have David Garofalo as our guest today to share his perspectives and some insight into his successes to date. And with that, I will pass it over to Mal to introduce David.
Thank you, Jen, and thanks to everyone for taking the time on what looks to be a very sunny afternoon in Vancouver. We're excited to have David as our guest today. David is currently the chairman and CEO of Marshall Precious Metals Fund and chair of Great Panther Mining Limited. David has had a remarkable career in mining to date. He has over 30 years of experience in the sector, spanning both the creation and growth of multi-billion-dollar mining businesses. A brief summary of his career includes most recently serving as president, CEO, and director of Gold Corp, which merged with Newmont in 2019, serving as president, CEO, and director of Hudbay Minerals from 2010 to 2015, serving as senior VP finance and CFO of Agnico Eagle Mines from 1998 to 2010, and serving as treasurer at Inmet in the 90s. David has also received numerous awards, including being recognized as the Northern Miners Mining Person of the Year for 2012, being awarded as Canada's CFO of the Year by Financial Executives International Canada in 2009, and Top Gun CFO by Brendan Wood International in 2009 and 2010. So with that, let's launch right in. David, thank you so much for taking the time.
Well, thanks for having me today.
So why don't we launch right into, giving a bit of more background from your perspective on your career, and, how did you get into mining to start with?
Honestly, just fell into it. I was a really junior accountant at Deloitte's in the late 80s, and really was looking to escape public practice, with all due respect to the people that are still doing that on the phone. And a headhunter called and offered me a very junior accounting position at Inmet, and worked my way up the ranks working for Richard Ross, who at the time was a young controller, and he worked his way up to CFO and then ultimately CEO of Inmet for about 10 years. So very, very capable guy. And I rode his coattails for about 8 years and learned the business from the ground up, initially doing some consolidation accounting. But within a year or so, he had me working on major project construction, the commercial elements of feasibility studies, going out to tender on big contracts. And we were constructing several mines at once at the time, Çayeli in Turkey, which First Quantum still owns, Bougrine in Tunisia, Troilus in Canada, Antamina in Peru, early stages of construction there. So it was great training ground for me in the early parts of my career, and then ultimately moving on to Agnico.
So what initiated the shift? It sounds like Inmet was a great platform to really grow into the business. So what initiated the move over to Agnico?
It was an opportunity to move up. Richard was still a relatively young CFO, and Inmet was going through some turmoil at the time. We had to divest ourselves of Antamina, simply because we just didn't have the balance sheet to afford our 50% of what then was a big project. $2 billion doesn't sound like a big copper projects in these days, but back then that was a big nut. And we ended up really selling it for sunk costs and Miranda and Tech. And there wasn't a lot left for me to do as treasurer at that point because we were looking at returning capital to shareholders and shrinking the company. And then Richard took it over a couple of years after that and brought it up to another level. But at the time, Sean Boyd, who had just ascended to CEO at Agnico, called me up. It's a small community; we all knew each other, and was looking to replace himself as CFO. And I loved his vision. I like him as a person, great guy, very down to earth, and bought into his strategy and thought this would be fun. And we were a very small company at the time. It was only $100 million market cap, one mine company with LaRonde in expansion mode. And we went over the 12 years I was there from 1 to 7 mines, and we went from 100 million and about 200 employees to a $10 billion company with about 6,000 employees. So it was really, really fun ride. So it was definitely the right decision for me to make.
That's a good point. It's hard to make those decisions sometimes. How did you kind of wrap your head around? I know, it's easy to lay out that it's a good, that it makes sense from a career move perspective, but it's always hard to leave people that have really helped you build your career, at Inmet moving to Agnico. How did you wrap your head around there? Is there any advice you can give to people who might be thinking about shifting in their careers?
Well, I think you have to buy into the vision and obviously the leadership of the company. And Sean had that in spades. He was only 38, a very young CEO at the time. I was a 32-year-old CFO, so we were all very young. But what appealed to me, it was a very entrepreneurial organization. And we only had 6 people at head office, 8 including executive assistants. And so that meant I got to have a fairly broad portfolio of things to do. At the time, I was doing finance, I was doing corporate development, I was doing legal. We didn't have a general counsel at the time. So I was doing a little bit of everything, and that really appealed to me at that stage in my career, and I think helped me, I guess, acquire the skill set that ultimately I'd require in running an organization. I didn't know it at the time, but it just appealed to me, having that kind of broad array of things to do. And again, underneath a very good leader, somebody who had a lot of vision, a lot of energy. And at the time, we had Ebe Shirkus as chief operating officer as well. He just got inducted into the Mining Hall of Fame, deservedly so. And so it was the 3 of us effectively building Agnico to what it became by the time I left in 2010. And so having that kind of company building responsibility and accountability was a lot of fun. And probably, at a 32-year-old, I didn't know what I didn't know. If I thought about what we would become, I probably would have been intimidated. But at the time, it just seemed like a fun thing to do with people that I really liked and admired.
You hit on so many good points in terms of things to look for, when you move forward in your career. Is there anything specific in that earlier part of your career that really was a turning point for you that kind of has stuck with you today that you kind of think back on from time to time when you're facing challenges?
Yeah, I mean, I think mind development, getting involved in that really, really early, and Richard Ross, thankfully recognized that I could do more things than just crunch the numbers and present financial statements. He thought it would be good for me to get involved at the project level, get down to the mine sites and the project sites, get together with the project teams and really understand the business from the bottom up. That was a huge turning point for me. And the fact that he recognized that I might have the skill set and the aptitude to pick up those skills was a big turning point for me. And I think ultimately set me up to go to Agnico, where we were in a perpetual state of mine construction almost from the day I started there. And so that gave me, I think, a skill set that was quite relevant to where Agnico was in its life cycle.
And with that move then, post Agnico moving to Hudbay, you'd been in the precious metals space at Agnico, had seen it grow. How did you make the decision to move over to Hudbay? And kind of wanted to touch a little bit on also your experience across commodities, given your background.
Yeah, in some respects, mining is mining. You're still moving rock and you're trying to do it as efficiently as possible, processing it, obviously, and extracting commodities. So there's a lot of similarities there. And what really led me to move from Agnico to Hudbay was almost a little bit selfish. I'd been in the role for about 12 years, and we'd been through the mine development, pretty much done, and we're going into a cycle of harvesting what we've been investing for the last 12 years. And I didn't feel like I had a lot to learn in the CFO role. And I sat down with Sean and said, and he's only 7 years older than me, and said, you're not retiring, are you? And he said, no, he's got a lot of runway. And to his credit, and he's still doing it. Yeah, 10 years later after that conversation. So it was clear to me that there wasn't a path for me to go much higher than CFO. As much fun as it was to work with him and Eve and what was a much broader organization and deeper organization. And Hud Bay was looking for a CEO at the time. And I thought, well, this is an opportunity for me to take a platform that had, at the time, $1 billion in cash on the balance sheet, all of it generated from operating cash flow, but really didn't have a pipeline. And so we could make it into almost anything we wanted. And that was exciting. But what also drew me to Hud Bay is, like Agnico, it had this deep operational pedigree. Hud Bay's been around for 100 years. And that workforce up in Manitoba is like fourth and fifth generation. So incredibly deep roots on the mining side. So a lot of parallels in terms of technical competence that I saw between the two organizations. So I was just trying to leverage what Hud Bay had and make it bigger. And that was exciting because we'd kind of done it at Agnico, but now we were doing it on the base metal side. And so I've spent about 15 years in each, the base and precious side, and I'm pretty agnostic as to which one. They're both exciting. To me, they're both very, very dynamic. They definitely have cycles that sometimes harmonize, sometimes they don't. Right now, precious is taking off and base is not so much, given the macroeconomic environment. But by and large, they're very, very dynamic industries to be in.
Sounds like you've been part of a lot of transactions, which coming from a finance background is fun. It's nice to see something grow, right, and be part of that. On that topic, actually, in terms of all the deals that you have been involved with, and I know we'll touch on Goldcorp Newmont as well, but is there one that has been the most challenging for you and that you can highlight?
Well, they all have their challenges, and it's funny you mentioned the deals, but to me, the things that I'm most proud of are the mine developments, and I've been involved in the construction of 13 mines in my career, and those leave a much more indelible imprint on my memory and my psyche than the M&A deals. By and large, the M&A deals, with the notable exception of Newmont Gold Corp, were relatively small. They were all generally acquisitions of early stage development opportunities where we could apply our technical expertise and our balance sheet to development stage assets. And that was all the M&A I'd ever done of any significance until I did the Newmont Gold Corp deal, which was a monster deal and completely different from anything else I'd done. I'd never done a deal more than hundreds of millions of dollars in value before Newmont Gold Corp, believe it or not. Every other deal was acquiring a junior stage company and again, using our balance sheet and development expertise to bring it to the next stage and de-risk the asset and create value. And that's, I think, how mining companies ultimately create, the only way mining companies ultimately create value is by doing that. So the deals are fun, but they're a means to an end. The Newmont Gold Corp was a different beast entirely in that what I saw as an opportunity to diversify our operating base quite significantly, trade into that, and get a significant re-rate for our shareholders. Difficult decision for me to make personally because I'm giving up my job to do it, but I don't regret it because the stock, if you were a Gold Corp shareholder on the day we announced that deal, you're up about 130% without dividends. So you've done very, very well. And that's what we ultimately saw is mitigating the risk that we had inherent in our own portfolio and spreading that across a much bigger portfolio and a much bigger balance sheet because we had a very good pipeline and we needed a bigger balance sheet in order to realize the potential of that pipeline.
It's so important to be able to make those decisions, right? Because it's about what's best for shareholders at the end of the day. And so being able to step back, and if that means that, you're losing your job and that's best for shareholders, that's what, you need to do. And it's a difficult decision, but it's important. So in terms of that transaction, what do you think were the top elements that were necessary to actually get that done successfully? Because given the monster size of that deal, we all know how hard those kind of deals are to get done. I mean, the smallest deals can be hard socially, to get across the line. So.
Well, there's a couple of things. I mean, one, there has to be some harmony between the two cultures. And Newmont has a very, very strong technical and operating culture. And I thought at Goldcorp, we were developing one as well. And as I said, we had a pipeline, Newmont less so. Newmont's operations were quite a bit more mature. And we had a pipeline of development stage opportunities that matched up well with their balance sheet. So they were facing a production cliff, like Barrick was before they did Randgold. For them, it was an existential imperative to do M&A. If you're not finding something in the ground, you're going to have to buy it, right? Because we're at the end of the day, mining companies are a collection of finite life assets. And so both of them reached a point where they saw their production declining quite dramatically over the ensuing 3 to 5 years. And so Barrick did Randgold in order to fill that gap, and Newmont needed to react. And so it was that chemistry in the air, if you will, that was happening across the sector more broadly that really drove these types of conversations. And so then the second thing I would say is social. I can guarantee you 9 times out of 10, 9.9 times out of 10, deals don't happen because people don't know how to partition the jobs. Who's going to get to do what? And so if there's a willingness on one side or the other to cede control, then deals will happen. Otherwise, they don't. And again, our focus was more on shareholder value and what would deliver the maximum return for our shareholders. And so we were quite comfortable that taking a premium on that deal would ultimately be in the best interest of our shareholders. So we had to give up on some social issues in order to attract that premium.
Well, and that speaks right back to what you mentioned before. I mean, so many deals don't get done because someone's not willing to step back and do what's best for shareholders. You touched on culture, which is actually a nice segue from our last webinar last week, where we talked a lot about that being so important in leadership and building a team and a successful company. Can you touch a little bit on your views on team culture and what you think makes a company successful from a cultural standpoint?
Well, I think it does start with respect for the individual in the organization, and that means having a very, very sound safety culture and ESG culture generally. Respect for stakeholders. So to me, respect is probably the underlying theme, the underlying term that really drives a sound culture, one that's sustainable over the long run. And if you have respect for the people around you, for the people within the organization, then you're ultimately going to make the right decisions. So I would say respect is probably the key word.
Yeah, it's a great point. And that actually kind of segues a little bit into our current environment of, putting people first, health and safety. So, we're living through a time that none of us have, well, I don't think anybody thought we'd be living through a pandemic. Right. Can you, I guess, reflect a little bit on how your experience has been the past couple of months and how you think, we're all surviving this current situation in today's world?
Well, I think I'm in the same seat as you. I'm not at the helm of an organization with significant number of employees. I am now the chair of Great Panther. It's got about 2,000 employees, but it is very, very much focused on the individual now. More than the collective, and ensuring that each of our individual employees are in good health, or in an environment where they are not coming to unnecessary harm or risk. I think it's become that much more fundamental. It's become much more human, and I think that's a microcosm of what's happening in society generally.
And how do you think companies, I think some companies are going to probably grow from this whole situation, the ones that adopt technology, and then some might actually struggle. What do you think is the key piece here, as people are evolving into kind of a new work from home and dealing with mental health and health and safety? What do you think is the number one thing that, companies and leaders in the companies need to focus on to make sure that their companies are successful through this?
Well, I think what's interesting is the focus will be very much on adopting technologies to make employees more comfortable about working in their workplaces. And those technologies, somebody said this to me the other day, what used to take us 5 years of study, we're studying in like 2 weeks and adapting very, very quickly. So there's less of that kind of hesitation to adopt technologies. It's become an existential imperative in order to continue to function as an organization. So I think you're going to see a lot more rapid adoption of remote technologies, tele-remote mining, things like that, that allow us to maintain physical distancing, which may become just part of our everyday life going forward, given what this pandemic has done to our economy. So I think that rapid evolution of technology, the adoption of technologies in the industry that generally has been slow to adopt technologies is kind of the theme of the day.
We actually do have a question from our audience. You've just joined the board at Great Panther. What do you see as the biggest challenge and or advantage of joining a new company in these challenging economic circumstances?
Achieving operational consistency. I mean, when you're with a small producer that's just absorbed a new operation, as Great Panther did in Brazil and Tucano when they took over Beetle last year, it's getting into a normal rhythm of operation. But then when you have something like this fall in your lap, which nobody has seen in our lifetimes, that just adds a layer of complexity and challenge to try and achieve that operational consistency. So, I think the challenge, the necessity of what we need to do is the same, but it's just become much more complex in the current environment that we find ourselves in.
Yeah, so why don't we touch on that, actually? I was excited to see the announcement that you joined Great Panther as a chair, so congratulations on that.
Thank you.
What specifically about Great Panther enticed you to join in the role? Can you give us a bit of background on that?
Well, I definitely want to be back in the gold space. I think it's a very dynamic environment given the macroeconomic environment we find ourselves in. Easy money, low interest rates. Gold's going to have a long run here. So it's likely to be a very dynamic part of the mining industry to be in. And that's what I'd like. I like to be in the middle of the action in terms of mine development, M&A. And I definitely see Great Panther as having that potential platform to do that. It's got a decent operating base. What it's lacked is operational consistency. And so we brought in a new CEO. The COO is quite new to the organization as well. And I've put quite a bit more operational emphasis on the board, bringing in my old COO from Hudbay, Alan Hare, on to supplement a couple of other former COOs on the board. So it's very much focused on turning around the operations and trying to reduce the disparity in valuations relative to its peers. Is a deep discount story, in my view, deep value. And the reason that is because of lack of operational consistency. I think the asset base is there, it just needs to perform better. That is a great challenge to have. It's better than trying to find ounces in the ground. You already have the ounces, you're just trying to extract them in an optimal way, in a consistent way, so the shareholders afford you the kind of multiple they generally afford companies that deliver operating performance on a consistent basis.
Well, and it's a good market environment, I think, to be trying to turn operations around, given that the gold price is in the right direction to kind of at least help support the margins, right, as you do the turnaround.
And the cost structures are going the right way as well. I mean, we have a perfect storm. You have local currencies that are depreciating rapidly against the US dollar. You have oil prices falling out of bed. And we're still, by and large, an energy intensive business, particularly with large open pit mines. And so this is about as good an environment for gold companies as you could imagine, both on the revenue and the cost side.
So we have a question actually that falls into the plans at Great Panther. So what is the plan with Great Panther? Foundation to build a company, Agnico 2.0? If so, M&A of operations or development assets? So I guess, is there anything in there that you can comment on in terms of strategy going forward?
Yeah, no, it's a platform for growth, clearly, but we need to bed down our existing business and deliver more consistent performance and improve our margins. We're going to be generating quite a bit of free cash flow over the next couple of years as we bed down Tucano and get it operationally more efficient and integrated into the organization. We already have a very good operating base in Mexico with Guanajuato and Topia. And so we have a foundation to build off of. But yeah, we see this as potentially a vehicle for M&A. There's lots of scope for consolidation among the smaller producers. And there's some obvious synergies regionally around our existing operations. And so having talks with our neighbors, whether it's on corporate combinations or joint ventures and the like, in order to realize those synergies. Look, if Newmont and Barrick can put together Nevada, then we can certainly put together joint ventures in some of the areas that we operate and realize those efficiencies that shareholders demand of us.
And, with the operational side and COVID right now, and you started kind of in the midst of all this COVID impacts on the business, in addition to the existing challenges that company is facing. How have you navigated that, and how has it been? Can you comment at all, I guess, on Mexico and Brazil and how each of those jurisdictions has been handling the current situation?
Yeah, irrespective of what they're doing at the national, even the governmental level within those countries, we've implemented very, very stringent health protocols for our employees, and we've been very, very proactive to ensure that any cases are isolated immediately, so that we don't have broader spread of the virus among our workforce. So it has become, as I said earlier on, a very elemental, human-focused strategy. It's very much focused on the health of the individual employee to ensure that we maintain the sanctity of our operations as well. So that's really what's changed. So, it's almost irrelevant what's happening at the national level, other than if there are decrees coming down, as they have in Mexico, to shut down the business, which we've had to do. In Brazil, that hasn't happened, but we applied our own stringent protocols to ensure that our employees' health is maintained.
And so actually, that's a great point. Just generally, right? You have to have your own measures in place, and it doesn't matter what someone else is imposing. You want to have the strictest policies, and if yours is stricter than theirs, then that's the right route to go down, right?
And frankly, over my career, I can think of many jurisdictions where we've had to set up business where there weren't things in place at the governmental level on stakeholder engagement, for example, and you've had to make up your own rules and your own rules of engagement with the local communities. And really what you're doing is following best practices and common sense, but how people should be treated and respected, because the laws aren't there or the governmental infrastructure isn't there to support it. You have to effectively act as a quasi-governmental organization in order to deliver the benefits and share in the benefits of your development in an equitable fashion with the stakeholders around your mine sites.
Yeah, no, I think that one of the takeaways I've at least taken away from the first half hour is really respect for everybody, the people you work with, the communities that you're in. I think that helps build the foundation of the culture, right?
That's right.
So to pivot a little bit, I guess, now into your new role at Marshall Fund, can you comment a little bit more about that? I thought that was exciting to see. It's a bit of a different, it's a shift from running a company. So if you can give us a little bit of background on what you're doing there and what the focus is.
Yeah, the fund is seeded by Zhaojin Mining out of China. They're a 1 million ounce a year producer in Shandong province in China. And I have a relationship with their head of business development out of Hong Kong, who's an ex-UBS banker. And he was working on some M&A files last year and asked me to help him. He was looking at a North American asset in particular that I was familiar with. And ultimately, they weren't successful in buying it, but he saw what we'd done at Gold Corp and Hudbay and Agnico in incubating juniors. And he thought that would be a great way to create some optionality in their portfolio. And so they've seeded us with about $25 million US of capital, and have asked us to invest that on their behalf in a segregated autonomous fund. But what they've also done, in addition to providing that seed capital, is provided us access to their technical people in Shandong, very, very capable underground operators, to evaluate opportunities. And so they've got a kind of a soft option on what we're investing in. They don't have preemptive rights, but by lending us technical people, then they're aware of what we're investing in, and clearly, if they like it, they may look at tucking it in. But we don't have an obligation to do that. But so it's the best of all worlds. And also, we've been afforded, the opportunity to raise outside capital, which we'll start to do later this year. My partner in the fund is Mark Prefontaine, who ran Grade Resources and Orla after that. Very, very capable geologist who complements my skill set. We're out there beating the bush for early stage exploration on the gold side and trying to put that seed capital work, because by and large, the juniors really haven't participated in any meaningful way in this gold price rally over the last couple of years. And the lag has been much longer than we've experienced in past cycles. And inevitably, given the decline in reserves globally among the established producers, the juniors will see sun. They'll see sunshine. And the seniors will start to pay attention. We'll have to start to pick up those properties. And so the juniors that are focusing on building out good geological models, building out resource bases, are the ones that are going to eventually garner attention from the seniors as they look to replace what they're depleting within their own portfolios.
Yeah, I'm hopeful of that. I work for a junior developer, so we very much have that same mindset as to kind of the setup in the gold space for developers seems to be very constructive. So what led you to the decision to run a fund rather than go back as CEO of a company?
Well, I've done the C-suite thing for a long, long time. I've been in the C-suite for 20 years. I know I'm still relatively young at 55, but 20 years is a long time to be in an operational role. Well, 30 years in operational, 20 years in the C-suite. It's trying to try something different. I've run mining companies. Now I want to pursue passion projects. And so investing in gold juniors is something that I've really enjoyed doing off the side of my desk for the last 10 or 15 years at Agnico, Hudbay, and Gold Corp. Now I can focus on it almost full time and then take on some board roles while I'm focusing on that as my day job. And so I've always been a big proponent of juniors. They are much more capable of doing greenfield exploration or grassroots exploration than the established seniors. I think many of you have heard me say this before. Juniors embrace risk. Senior producers mitigate risk. It's a completely different mindset. That's why you never see a lot of good grassroots exploration done in seniors, and why you never see good mine developers in juniors. It's completely different skills, different mindset. And so ultimately what juniors should do is, when they've discovered something of critical mass, is try to run an auction process and invite the right players in that have the balance sheet and the development expertise and the risk mitigation expertise needed in order to develop these assets into productive mines.
On that topic, do you think that there's sort of a key point where it makes sense to do that? What do you think more senior companies looking for in terms of that de-risking before they're willing to step in?
I think they're looking for a sound geological model with a critical mass of reserves that they think they can develop into something that's meaningful within their portfolio. And so that's different for different companies. Obviously, if you're a Barrick or a Newmont, you're looking for 10 million ounces a year of new reserves to replace what you're depleting. So that means they're looking for elephants, or ones that have the potential for elephants. But if you're a mid-tier company, then you're probably looking at something much smaller scale, but you're still looking for some critical mass in order to add something into the portfolio that would be meaningful in terms of additive, in terms of the production profile, or meaningful in terms of replacing what's being depleted.
So on the investment side, I have a question that I think everyone has their own answer to. Curious on yours. What's more important when you're evaluating a potential investment opportunity, the management team or the assets?
Always the geological base. Managements can't be replaced. Can be replaced, but you can't put ounces into the ground or tons of copper in the ground. It's got to be a good geological address. It's got to be a good geological model. That's fundamentally what attracts capital and attracts good personnel.
Yeah, it's an interesting question, just because everyone's got their answer to it, and I think sometimes it's a combination, but yeah, I agree. I mean, you can't change the asset, right? And you can't change the team. When it comes to this current setup for precious metals and equities, I guess, what's your preference, base metals over gold, and how do you think this compares to previous setups you've seen, where I think there's potential to make money in this industry right now?
Yeah, can I say both? I mean, I have the luxury of being able to dabble in both, quite frankly. Aside from running the Marshall Precious Metal Fund and sitting on Great Panther's board, I've been pursuing things on the M&A side in the base metal space. I've been trying to catalyze some things there because we're at the bottom of the cycle and near the bottom of the cycle for base metals. But inevitably, particularly on the copper side, I'm very, very bullish in the medium term. And if we can create some vehicles in Canada of sufficient scale, when that cycle turns, it'll turn quickly and violently. And the best and largest players will attract the most capital and the lowest cost capital. And that creates a bit of a virtuous cycle, if you will. Scale does matter, as has been demonstrated more recently in the gold space with some of the combinations that have occurred. We haven't seen that kind of scale on the base metal side, aside from the big diversifieds like Rio Tinto and BHP and whatnot. But in the base metal space, there's a lot of small players and not enough scale. And I think we need to create scale, and we have the capacity to do that in Canada. Frankly, what I found, as I alluded to earlier on, is social issues are a big challenge. Some of these companies are lifestyle companies, and it's tough. It's tough to get these companies together and realize this is when you should do it. Do it at the bottom of the cycle when people aren't paying attention, and those social issues are more manageable. It becomes much more difficult at the peak of the market when everybody thinks that they're geniuses, right? And right now, there's a lot of scope for synergies among the base metal space and creating that kind of emerging large-scale producer that will attract that institutional money and will ultimately re-rate as the copper cycle starts to come to life.
Yeah, it's an interesting point too. I think even in the gold space, sometimes it makes sense to do deals when things are cheaper and you got the re-rate and the synergies, and you can reduce your corporate overhead. And it'll be interesting to see if history repeats itself, right? We do tend to see these rushes and people overpay because there's momentum in the sector. Although I think any kind of momentum and positivity is good too. So on that topic, I mean, it is a hard industry, right? Sometimes these cycles last 5, 10 plus years. And, I think a lot of people that are involved in YMP also are younger, so they haven't necessarily seen a good cycle. I mean, I'm about 12 years into my career, so I saw the tail end of the last good cycle. Do you have, any advice, I guess, to our members in terms of, what it takes to really stick it out and why you stuck it out despite all those challenges?
Yeah, honestly, I'm going to say the first 15 years in the business, I was wondering, like, are we ever going to make money? Because from 1990 to 2005 was a pretty crappy environment for both base and precious. I mean, just to give you some perspective, I saw a 200 handle in front of gold for most of that time. I saw copper at 60 cents, 70 cents, 80 cents for most of that time, and zinc at like 20 and 30 cents a pound for most of that cycle. But the investment you can make in an industry and the network that you build and the community you build, if you stick it out, really does pay dividends when the cycle does turn, because it is a cyclical business. Just recognizing that. And when the going gets tough, issue stock options, right? Bottom of the cycle, it's going to be great when the cycle turns, because when it does turn, it never goes up in a nice gradual fashion, even though analysts like to pretend it does. Their price decks are always very gradual and flat. That's not how it works. It happens quickly and violently, and the capital just comes rushing in. It's like a bunch of herd of elephants trying to go through a door. That's how it happens. And so, stick it out, acquire the skills that you need to acquire during the bottom of the cycle. Though we're not experiencing it now, particularly in the precious side, but this is the time to kind of make those seed investments, anticipating the cycle will turn, particularly on the base metal side.
And do you think it's still early days? I mean, I think on the precious metal side with some of the senior producers, it does seem like we've already seen a bit of, wind in the sails with their equity moving up. But do you think that this is kind of just the start of the next cycle? Do you have any thoughts on that?
Yeah, no, I do. I mean, I go back to the macro factors that are driving the gold price. I don't know when we're going to see an end to quantitative easing given the environment we find ourselves in. And we were already in that kind of debt cycle even before this. And it was clear that the central banks would have to print their way out of debt because the level of indebtedness is unprecedented even before COVID. And so the only way to deal with that, if you can't repay the debt, if there's no fiscal means to do that, is to print your way out of debt. And that's what's happening, and it's likely to happen for the foreseeable future. They're desperately trying to create inflation in an environment that's actually quite deflationary given the advent of technology and what that's done for cost structures across our economy. So they're kind of pursuing an old monetary model in a new paradigm for our society. So that's driving a lot of paper into the system, which ultimately is going to be very, very bullish for gold and has been very bullish for gold. And that kind of inflationary, those inflationary measures central banks are taking will ultimately drive up hard asset prices on other commodities like copper and whatnot. So a lot of those dynamics that are driving copper consumption, I think, are going to come back once we get out of this period of uncertainty.
Yeah. On that topic, I'm going to pivot to some questions that flow into that. So when you look at the current pandemic as compared to previous financial crises, do you see more parallels or differences? And are there lessons learned from previous times of challenge that are helping you through this crisis?
Yeah, the big difference I see between the great financial crisis of 10 years ago and now is the disappearance of, well, not quite the disappearance, but the Chinese super cycle was a big factor 10 years ago. And so we saw broadly harmonized increases in both base and precious metals. And that's not the case now. There isn't that kind of macroeconomic support, at least at the initial stages of what we're going through. And so what that created 10 years ago was an environment of extreme inflation and input costs across the mining industry, because both base and precious were competing to rapidly deploy capital in new development to feed what they thought was an insatiable demand for their commodities. And so we saw a rapid erosion in multiples in the sector and in margins. We saw the metal prices go up, but we saw our cost structures actually go up even more so. It's a completely different dynamic now. Gold companies are largely deleveraged. They're not developing large-scale projects to nearly the degree they were 10 years ago. And as I said earlier on, cost structures are actually coming down, just given where energy prices are going and where local currencies are going relative to the US dollar. That's just driving cost structure. So completely different environment. Free cash flow is now the new religion among gold producers in particular.
It's nice that something has stuck from the last cycle when when I think things went a little haywire. I think that that dedication to cost control and understanding that you're operating your business as a business for profit, not as a lifestyle, right? So, what are your top 3 must-haves and lessons learned during your years developing projects?
Yeah, a few things. One is make sure you have the capital. I can think of a number of circumstances where I was probably caught a bit short. The story I like to tell is I won CFO of the year in 2009. And the reason I won is because we had to do an extremely punitive financing in late 2008 at the height of the credit crisis when we were building 6 mines at once at Agnico. It was the most expensive financing of my life. I was embarrassed to have to do it because I clearly didn't squirrel away enough nuts when prices were better earlier in 2008. Given this big capital nut we had ahead of us. But I thought, well, we'll zinc at $2 and gold was flying at the time and copper was fine. Well, we have more than sufficient cash flow to fund our capital internally. Well, that evaporated almost overnight when the great financial crisis really took hold. And I went hat in hand with the Canada Pension Plan and got a financing done, which ultimately unleashed our share price and made me look smart, but I was an idiot to have to do it in the first place. That was an indelible lesson for me is you never have enough capital in our business, particularly when you're in a development cycle. And when you're developing mines, ensuring that you have a very strong owners team at the project level with ownership of the budget and all of the major decisions, and not turning over accountability and responsibility to an outsider is a lesson I've learned time and again. There's no such thing as a turnkey contract or fixed price contract, no such thing. Engineering companies do not assume risk. Engineering companies make excuses when things go wrong, and they'll charge you for it because they don't have the capital. So that you have to just recognize the reality that as the plan or the project sponsor, you're ultimately responsible for any cost overruns, any risk associated with that. Engineering companies don't assume risk. They don't. They pretend to, but they don't. And so that's a very significant lesson I've learned on a number of projects, both large and small. Ultimately, you have to build up the project team in order to take that accountability in-house and really subcontract components of the project, but ultimately maintain that control in order to maintain your budget and maintain your timelines.
That's such great and invaluable advice, because ultimately your team is actually, they're aligned, right? They're incentivized. Your contractors and your consultants, at the end of the day, you know, if they have to charge more, they will. And they don't own it the same way, right?
That's right.
So on the topic of Agnico, question, when you joined Agnico as a young CFO with a young CEO, how many mines, did you have? It's amazing what you guys did with the company. Did you have a large shareholder or financial partner that was supporting you guys? Did you establish a strategy and just execute, or did it happen more organically?
Well, it was somewhat organic. I remember when I joined, and we were like 100,000 ounces a year of production from just the LaRonde mine, and it was the old shaft number 1, which has subsequently been shuttered, and we were just developing the Penna shaft. So it was almost like building a new mine right beside the existing one. We said, wow, wouldn't it be great if we were a 1 million ounce producer someday? And, kind of half laughed at it, but that's kind of the overarching vision we had. Somehow we'll get there. But we would do that by sticking close to our knitting and leveraging our technical expertise. Agnico has been around since the 1950s, and they had a very strong operating base up in northern Ontario, northwestern Quebec. And so leveraging that was really how we saw ourselves ultimately being successful. And we stitched together the Lapa mine, or Lapa project at the time, a few kilometers away. And then the Goldex project had been in inventory for like 25 years. And ultimately, through re-engineering efforts, we made that into a viable mine. And then we started buying mines in good jurisdictions, or deposits, I should say, good jurisdictions that we thought bared a geological resemblance and a mining resemblance to what we were doing in northwestern Quebec. So again, we were trying to stick close to our knitting and diversifying into other jurisdictions, but not high-risk jurisdictions. We went to Finland, we went to Mexico. We started acquiring things in the Arctic, built the Meadowbank and Meliadine mines there, Kittilä in Finland, but again, in an Arctic environment we're very comfortable with, having operated in northwestern Quebec. Mexico was a little bit out of our wheelhouse, but still a good mining jurisdiction with great pedigree, and open pit, which we'd never really done before. So it helped us diversify, but relatively small scale open pit operation with underground potential. So it was very incremental in nature, but there was an overarching vision. And it was a bit of an audacious vision for a company with, really 200 plus employees, $100 million market cap, 100,000 ounces a year of production, and 3 young guys who didn't know better, right? And thought, oh yeah, we could do this, but it was a 12-year exercise. It didn't happen overnight, but it was very, very incremental in nature.
You have to dream big, right?
Yeah.
You seem like an ambitious person, which I can relate to. So I feel like if you can't dream big, then what are you working towards if you don't have those dreams, right?
Yeah, absolutely. Yeah.
So on the topic of growth and M&A, how would COVID travel restrictions impact M&A deal activity? Doing site visits, meeting face-to-face, et cetera, could prove to be difficult until a vaccine is created. So how do you see mining companies tackling this issue?
Well, you're probably better equipped to answer than me as a head of corporate development, but I think it is going to be an impediment to ultimately consummating deals, because there is an element of physical due diligence you just can't get around. I don't know that you're able to really make a major or meaningful investment in a new venture without having physically visited the assets and talked to the employees. I mean, there's a limit to what you can do via Zoom. That's the reality. That being said, given that there's less of an operational imperative in our day-to-day right now, there are a lot of mines, like 300 plus mines, that are in a state of suspended animation right now. It actually gives the senior managements and the boards of these companies some breathing room to kind of sit back and think strategically and say, okay, well, what's going on out there? What's available? What could fit in well with our portfolio? And I bet you there's a lot of these conversations. I know that there's a lot of these conversations going on. Frankly, I'm in a few of them. And so these strategic conversations are probably increasing in frequency. And when we come out of this and we're able to get physically to sites, you may see an acceleration in M&A and a kind of a culmination of the conversations that are going on right now.
And I wonder if it'll actually be smarter M&A to a certain degree, because I completely relate to your point that now that everyone's stuck at home, I think strategy has become much more of a focus, and there's actually the time and effort to put into strategy that before it was a little bit more distracted with travel.
Yeah.
I think it'll make for a very interesting setup once some of the restrictions are lifted.
Yeah. But look, the dynamic is there. As I said, reserves are down, I think 50% in the gold business last 7 years, and that's almost entirely due to depletion. And so there is still a tension there that needs to be dealt with in terms of replacing what we're depleting as an industry. But also the dynamic in the gold price, tells you that you're getting a lot of attention from generalist investors, and generalist investors like scale. They want liquid names. And, I dare say, I look at Equinox, what they've created there is a company of relevance by putting a lot of assets together and making themselves big enough to be relevant for indices. And that's resulted in a re-rate, and I'm sure there will be synergies they'll be able to realize through putting these companies together. But I also think that scale was extremely important, and an important underlying thesis to getting that deal done.
Well, and it can be challenging to make those decisions, right? When from the outset it might not seem supported. So on that topic, we have a question. How have you managed moments in your career when your decisions as a CEO weren't supported by investors? And I'd actually phrase that as investors and potentially maybe your team, or maybe there were disagreements on your team as to the best path forward.
Yeah, you know what? That almost describes virtually every major investment decision I've been party to in 30 years. Investors cannot see beyond the end of their nose. And that's only been exacerbated by the onset or influx of index funds, right? There's nobody to talk to in those circumstances. And those index funds are necessarily driven by short-term metrics. And so if you're making an investment decision that won't see any benefits for 5 or 6 years, those index funds are going to turn you off. The algorithms are just going to turn against you. And so you need that kind of steadfast and sticky capital that's disappearing in our industry. And the capital that is still discretionarily being managed sometimes almost acts like an index to survive. They're hugging the index just to stay in business and keep capital. And so you're seeing, I think, the majority of capital in our industry acting like an index fund. And so that's a significant challenge. But it's always been a challenge. When you've had to make those long-dated investment decisions, you generally get shat on, quite frankly. But we need to do that as an industry. We need to redeploy capital back into the ground to replace what we're depleting. So it's just kind of sticking to your guns and getting it done. I had a conversation with Peter Maroney, just a couple of weeks ago, and Peter was telling me about an institutional investor that came back to him recently and said, that Brio deal you did when you IPO'd it, I thought that was the stupidest thing you ever did. Boy, that was brilliant. I just have to come back and admit to you, I really gave you a hard time. I was wrong. And that investor actually pointed out the Chapada sale as well. He was skewered for doing that sale last year or 2 years ago. And that same investor said, I got it wrong there as well. And so sometimes you're going to have more perfect information as an insider than an investor will, and your motivations are going to necessarily have to be different. You're going to have to be more long-term oriented than an investor can be. So I'm not saying investors are stupid. I don't want people to take that away. They're boxed in. They are boxed in. And it's rare that there's a pool of capital out there that has that kind of long-term view, or is allowed to have that kind of long-term view. They, and a lot of these generalists, as they come in, are going to be comparing you against Apple and other industries. And, so they're going to be very agnostic. They're not committed to mining. They're looking at it in very bloodless terms and cool calculating terms. Is it going to give me a better return than it would in the technology or financial services sector? And so just recognizing that and not vilifying it. It's just what it is. What it is. It's what the capital markets is. These are not bad people, but the system is set up in a way that they have to behave a certain way, and you have to behave a different way. And you may not see eye to eye from time to time, and you'll get beat up for it. That's life, you know.
Yeah, no, absolutely.
Develop a thick skin.
I think it makes you a stronger CEO ultimately, because you can prove out that you've created value. But also, I mean, unfortunately, investors, depending on when they got into the stock, what's driving their motivation is very different than, you know, as a mining company driving long-term fundamental value, right?
Yep.
And you can't pick when that investor came into the stock, whether it was at a 52-week high or 52-week low, which then gauges their sentiment generally on if they're happy or not with the performance. So.
Yeah. Don't get me started on the press, or even worse. So they have a 4 o'clock deadline every day, and that's how they think. I mean, it's even shorter term than investors, and they can be quite unforgiving. Honestly, I can tell you like what happened to us at the press last year, and to me and Ian in particular. I honestly stopped reading papers for 3 months, because if I started reading about what was written about me, I wouldn't have been able to focus on my job. I had a task at hand, and sometimes you just have to put blinders on. If you know you're right, you're doing the right thing for the right reasons, just do it, and ignore the people that are, you know, trying to bring you down for a variety of reasons. You know, again, the system's set up; they're not bad people, but the press has to file a pithy article every day at 4 o'clock, and so they're looking for something salacious and sensational. Bloggers are the same thing, and then institutional investors, you know, they're judged every quarter.
No, and it's almost gotten worse too, I think, with technology, the way that it's gone, just across the spectrum, whoever you are, you know, online bullying, and we don't have to go down the path of discussing all that, but obviously people believe that there's been a bit of a disconnect, I think, between people understanding that there's a human on the other side. But we won't go down that track.
Thank God I never got onto social media. I still don't have
Thankfully,
my LinkedIn profile, by the way, was created by Gold Corp's people, and I haven't touched it since. So I'm still not on social media.
You know, on that topic though, you have given back so much, and we haven't had much of a chance to talk about that, you know, in terms of charity and giving back. So just want to comment a little bit and wrap that into, you know, with Gold Corp no longer being in Vancouver, you know, how do you see that evolving in terms of that, filling that void? Will someone step in to do that?
Yeah, look, no doubt that Randy Smallwood, Don Lindsay at Wheaton and Tech, respectively, stepped up big time. Ironically, Randy came out of Gold Corp, and so did Wheaton. So what I found is the industry is a little bit like a shrub in Canada. You can trim off the top, but the roots are quite deep, and it'll spring back. And I found that time and again. I don't think we miss Inco and Noranda and Falconbridge. Other companies have come out of that, and some very, very good people came out of that. And that human infrastructure, the DNA that we have in the mining industry, is always going to be there, and we tend to regenerate ourselves. And I've been tracking all of the great people that work with me at Gold Corp into new jobs and new careers, and they're doing wonderful things in new vehicles in the mining space, and they're making the next senior. So I have every confidence that Gold Corp is already being replaced in that kind of social conversation.
That's great. And it's the people. I mean, I love people in mining. That's why I've stuck with it. So it's a good community. Just going to wrap up because we are running out of time with one final question for you. You know, what advice would you leave our members with who are just starting out in mining today? You know, if they wanted one takeaway you think is really, really important that they walk away with.
Well, two things. I'd say stick to it because if you stay in an industry for the long term, that network is really your franchise. You know, the people you know and the people you can call up to get things done is your franchise. That's really what's going to define you and make you successful ultimately. And my second bit of advice, and I give this to every kid that gets sent my way from, you know, friends of mine who have kids leaving university and saying, can you talk to my son or my daughter? And they need some advice on what to do. I said to them, like, just show up. You know, though notwithstanding that you can't show up right now, you can't go to the office right now, but if you show up, things are going to happen. If you're not in the room, you're not in the deal. And so make sure you're in the room and you show up every day and put on your pants and go to work, Just, and so though I expect that some of you do not have your pants on today as you're doing Zoom. So
thankfully none of them are on video. So David, thank you so much. This has been such a pleasure. It's been nice to get to know you over the last hour. And thank you for sharing your insights with everyone. And thanks to everyone for attending, to our sponsors. And stay posted. We will have more virtual live events coming at everybody. Hopefully sooner than later, we'll all be able to see each other. But in the meantime, everyone stay safe, healthy, and everyone enjoy your evenings. Thank you, David, so much.
Thank you.